Would you like to build a property portfolio using other people's money? In this video, we're going to break down the steps required to access equity and build a portfolio without paying lenders mortgage insurance. So Emily and I were able to build a $5 million property portfolio. And the way we did that was one property at a time. We were using the bank's money to continue to refinance and build our asset base. And so the first step in building a portfolio is to look at the assets you currently have. Now for us, our first property cost around $800,000. And let's say for easy numbers that it went up to $1 million worth of value. Part of that reason might have been because we undertook renovations on the home. We knocked out walls, we added a kitchen, we upgraded a bathroom completely, and that's what added value to the property, as well as the market growing over time. So our property was bought for $800,000 and revalued, or current market value was around the $1 million mark. So do this for yourself. Look at your own home, look at your investment properties. What current assets do you have in play? And what are they worth? And are there ways you can add value to those properties before looking at the next steps? This leads me into step number 2, which is calculating your equity. So in our example, when we bought our first home, say for 800 grand, and now it's worth $1 million through renovation and through some capital growth, the next step was to calculate the available equity. Now, for easy numbers, let's say there was 600 grand of debt on that home as well. So it was originally bought with a 75% LVR, 25% down, and 75% debt from the bank. Now, the way I like to do this is grab out my phone, open up the calculator and punch in the numbers. And so in this easy example, all you need to do is take $1 million and times that by 80%. That'll show you that you've got $800,000 that you could potentially increase your debt to. So if your debt was 600 grand, you could potentially increase it to 800K without paying lenders mortgage insurance. So now we know that we have equity in our property or properties. Now we can go have a chat with a broker or a bank and formalize this. This means getting pre-approved for your finance. So that is step number 3, is chatting with these brokers and banks, understanding whether you can access that 200 grand of equity. Now, a hot tip in building your property portfolio before we move to the next step is to make sure you're structuring your loans in a tax-effective way. This also reduces the paper or admin required at the end of each year. So if you're drawing equity out of your own home, generally it's best to get it in a separate loan. So have the original loan of 600 grand in our example, and another loan for a 200 grand to draw out the equity for investment purposes. This means if your first property, using my numbers, was 600 grand and that was owner occupied debt, and you drew out a second loan of 200 grand that was for investment purposes, the 600 grand will be non-deductible and the extra 200 grand would be deductible for tax purposes because you're using those funds for an investment property. So there are different ways to tap into your equity. You can do this when the loan settles. You can do this and get cash like Emily and I like to do, or some brokers encourage people to do this at settlement for an investment property purchase. I myself much prefer having access to the money and having control of making my decisions. So step number 4 for me is cash out refinance of your equity available. This means for Emily and I, in our biggest scenario, that we were able to draw out over $700,000 at around the age of 26 or 27 from CBA to go and buy our next investment. Now, you do have to share all your numbers, your identification, your plans for using that money, but they will give you the cash if you're willing to do a cash out refinance. That's definitely my preferred option because you end up with the cash in your bank and then you can control when you go and put that money down for a deposit. If you go for scenario 2, where you let the broker refinance once you've got a property under contract, that means you're refinancing the new home that you're purchasing or the investment property, as well as refinancing the original property that you're pulling equity from. I'd much rather personally get that equity sorted earlier and get the cash out rather than doing 2 refinances or 2 loans in one go. Now, also to talk around structuring, make sure your broker doesn't cross-collateralize your assets. As you're looking to grow this portfolio and use 20% deposits, which suits my risk profile, then you want to make sure that the bank doesn't tie the assets together and control your entire asset base. All this means is you want to have separate loans for separate properties and make sure everything is kept separately. So if you want to discharge or sell one of your assets, it doesn't affect the other properties in your portfolio. The banks generally like to encourage newer investors as they build their property portfolio to cross-collateralize their assets. CBA tried to do this to me as we were building our property portfolio. They made the suggestion that it would be much easier to have one loan that will simplify everything and you only have one repayment to think about. But I understood at the time that having separate loans for separate assets made sense to keep our securities separate. The reason you want to keep the assets separate is so you can move each property to a different bank if you want to, and it gives you more flexibility as you build out the portfolio. Also, when it comes to refinancing and drawing out equity, it means you can take property A to a different bank and property B to a different bank without those assets being tied to the one lender. Whereas in a scenario where you're cross-collateralized and an asset increases and an asset decreases, you might not be able to draw out any equity because the assets are tied together in a pool of assets with the one bank. So keep all of that in mind, that you don't want to be cross-collateralized. Now we've got the funds available and we've drawn down on our equity, it's time to go out and secure an asset. Now, this means it needs to be investment grade. So you want to look at the fundamentals of that purchase. You want to look at how that property fits into your larger property portfolio. Now, for Emily and I, sitting at around that $5 million mark, our next step is to potentially buy a coastal property because that's something that we're interested in. Another option could be a house and granny flat because I can see a lot of value and strong cash flow from that type of deal. Or the third option could be looking at the motel game. So maybe a $2 to $5 million motel, and that's another option for us. The reason we're looking at those strategies is because they're higher cash flow or we have an interest in those deals. Now, for most people, buying a bread and butter property or building their asset base is what they need to do first. You need to find assets that have strong fundamentals for growth, as well as a reasonable level of cash flow for your situation. It's going to be different for different people. Everyone's got different needs, requirements, financial capacity in terms of the investment property you can buy. And that's why it's important to analyze the growth and the cash flow that you're looking for on that specific deal and how that deal can help you get to properties number 2, 3, and 4, and so on. So once you've acquired this asset, this next asset, it's time to reevaluate every 6 to 12 months. This could mean boosting the cash flow, maybe doing a renovation, maybe adding that auxiliary dwelling, or subdividing a block. Whatever levers you can pull, it's now time to do those things or do those renovations is what Emily and I have focused on to add value to the property to fast track your journey. Otherwise, you're reliant on the market growth and then pulling out that equity to continue growing your asset base. Now, why has this video been focused on doing this with 20% deposits? The reason being is I generally like to build the portfolio with a moderate level of risk. For some people, they would think my approach is very risky. For others, they would think I'm very conservative. And so that's why it's a personal decision how fast or slow you try to grow the portfolio. You could go out there and try and take on 5% loans with second or third tier banks and try and extend your borrowing capacity as much as possible that way. The way I see it is you should try and build your asset base with the big 4 banks. Once you hit a serviceability cap with the big 4 banks, it's time to start talking with multiple brokers and looking at second and third tier lenders. I would still be using the strategy of putting 20% down because you want to have some skin in the game, and it also reduces the fees and the interest rates you're going to be paying as you build the property portfolio. And this is exactly what Emily and I have done. We started building the portfolio with CBA. We were able to acquire around $3 to $3.5 million worth of assets before we got stuck with CBA. And then we looked at second and third tier lenders to build the property portfolio. That's how we were able to draw $700,000 of cash from CBA and take those funds to a second/third tier lender in Pepper Money to buy our unit block in Coffs Harbour. Now, with the interest rate rises, I'm actually looking at refinancing our current property portfolio. Some of our deals are locked in at fixed interest rates till around December this year, and some of our loans are on variable interest rates, even up towards the 8% mark. This means working with a broker and bank to find the best product for you. And so I'm going to be chatting with our broker in the next month or two, and I will reveal who they are and give some feedback on that broker and where we land in terms of our financial result. So you might be able to work with that broker as well. And I'll share my open and honest experience. When it comes to building your portfolio, you need to reassess your assets, look at leverage, look at your serviceability, and continue to grow. Now, a lot of people are going to get stuck. So that's why I suggest start with the big 4 banks, then move to the second and third tier lenders, and obviously try and increase your income and reduce your expenses as much as possible as you build the portfolio. If you're interested in seeing some of the detailed numbers on the cash flow of our property portfolio in the last 12 months, then click this video over here. Thanks for sticking around. I'll see you in the next one. Peace.